Good morning, and welcome to the First Property Group preliminary results for the 12 months to 31st of March 2013 conference call. Throughout today's call, all participants will be in a listen-only mode, and afterwards there will be an opportunity to ask questions. Just to remind you, this conference call is being recorded. Today I am pleased to present Ben Habib. Please begin your meeting, sir.
Good morning, everyone. Thank you very much for attending this conference call and our meeting in the office. We announced our results for our preliminary results for the year to 31st March 2013, and I hope that all participants have got a copy of the results as well as the brief presentation that we put together for the results. What I intend to do this morning is to go quickly through our presentation and then open up for questions and answers. So turning directly to the presentation, starting on page 5, on the presumption that the preceding pages are introductory by nature and people would have read them. On page 5 we give a snapshot of the financial highlights for the year to 31st March 2013. And essentially, the year was a year of treading water for the group. The year was dominated by the sovereign debt crisis in Europe and the consequential turbulence in capital markets, which made us quite nervous of buying property both in the UK and in Europe. So the year looks as if we've been quite inactive, and profits consequently have basically tracked the existing portfolio that we manage without any new additions as such. We bought one property for 4 million during the year, but that was the extent of our demonstrable activities. So in line with that backdrop, our profit before tax was down slightly. That is in fact steady as she goes once you strip out foreign exchange, the effect of foreign exchange differences. So even though it looks like pre-tax profit is down, in fact pre-tax profit is steady. The EPS figure is down by 20%, and again that looks markedly down, but in fact is as a result of tax charge rising on the reversal of a deferred tax asset that which we previously held. So the 20% reduction, in fact, is again steady as she goes, notwithstanding the fact that 20% appears to be quite a large reduction. Given that the company has basically trodden water for the last 12 months, we have maintained our dividend at 1.08 pence per share. And then the segmental breakdown for the business reflects what I've described at a group level. So the fees that we earn from asset management are down slightly, and the fees that and the profits that we earn from group properties are down slightly more than the fees on our fund management business. But that's before the allocation of central overheads. And then the next few lines give some understanding as to what FX has been up to. It's a kind of peculiar year for foreign exchange movements because the predominant part of the year was spent with a weaker euro, which meant that our profits were adversely affected. But just before the year end, the euro strengthened to a level that was higher than the previous year end close. So it looks like we ended the year with assets at a slightly better level than the previous year in terms of foreign currency translations. But in fact, the overall effect of foreign currency movements during the year was adverse to our profits. Given that we did make a profit, our net assets are up. Our cash balances are up more than our profit level, and that's because we sold a property halfway through the year on which we reported at the interim stage. The split of our properties is still the majority in Poland with 71% and 26% in the UK. We've had no additions or sales of properties in Romania, which sits at around 3%. Turning over the page, operationally, which I've touched on already, assets under management reduced by 3.3% as a result of adverse capital value movements during this turbulent period. We made one property purchase of 4 million. No properties were sold by any of our funds. We sold that one property. The group sold a property for 2.3 million just before the half-year stage. And even though we had quite an inactive year in terms of sales and purchases, the ranking that we were attributed by IPD for the 7 years to 2012 still brought us out at the top of the CEE table, about which we are naturally proud. Page 7 is another slide that we've produced for the last few years, and it tabulates our dividend payout since 2008. And we're also proud of this slide. We're into our sort of 6th year of a credit crunch, but we've maintained or grown our dividend throughout. Our profits, for what it's worth, at 31st March 2007, so the peak of the bubble, the pre-tax profit for the group was 1.2 million, and we're now 6 years into a credit crunch, and the pre-tax profit for the group is 3.5 million. We haven't had to do any rights issues or share placings to sustain ourselves during the credit crunch. So we see our performance, as having been a very good one in view of what's been going on in the world since 2008. On page 9, we give a breakdown of profit before tax by various segments. Again, this reflects what I've already said, which is that fund management fee income was slightly down, profits earned from group properties was slightly down, both largely as a result of foreign exchange differences, and nothing really more to report there. On page 10, we give a breakdown of the various funds under management. The USS fund remains the largest fund that we manage. As shareholders who have attended or read our previous reports will know, that fund expires in August 2015. August 2015 is now 2 years away, so we are working towards a resolution of that fund. We don't think that resolution will have any overall adverse effect on the group's profitability in aggregate over the next couple of years, but clearly, we need to do something as a group between now and August 2015 to replace that USS fee income. As mentioned, we've got £13 million on the balance sheet, which we will not be shy of deploying for the right deals. Having been quite shy last year of the markets, we are much more confident now of making purchases, and so we do intend to deploy that 12-13 million we have on the balance sheet over the next 12 to 24 months, and we would expect to replace the lion's share of the USS fee income, if not all of it, by the time we report for the year to 31st March 2016. The proof of the pudding, of course, will be in the eating, so we can't say, with absolute certainty what's going to happen, but, we are confident of that position. Our second largest fund is our UK pension property portfolio, which expires in 2017. That is now nearly fully invested, and we've got about 5 or 6 million to invest, which we expect to conclude this year. So looking forward at our assets under management as a breakdown, USS the biggest, UK PPP second, with FOP at 6%. We do expect FOP as a percentage of our fund breakdown to grow over the next 12 to 24 months, as I mentioned, and we therefore expect the profile of our investor group to change as well, away from pension funds towards high net worth individuals and family offices over the next 12 to 24 months. We've got no ability to accurately predict whether our assets under management in Poland will grow faster or slower than our assets under management in the UK, and the reason I say that is that we are very deal-orientated fund managers, so we will simply buy properties wherever we think the best deal is on offer, and that may be Poland, it may be in the UK. We have different strategies for Poland and the UK, and it just depends on where we're able to identify more attractive assets. Moving on to page 12, we now only own one property in the group directly, which is the 28% interest we have in an office block in Warsaw called Blue Tower. We bought that property in December '08 for about £8.3 million. We hold it in our balance sheet at 8.3 million. It is in fact valued at 12.9. It's proved to be a fantastic investment for the group. Last year it contributed £962,000 to earnings, which represented a return on equity invested in the property of 48%. And it's sort of done that for the last 3 or 4 years now, and we expect it to continue doing that. So it's a tremendous income earner for us. We are keen to buy more of that building, and we hope to report positively on that in the next 6 months. We also own shares in the various funds we manage, which are tabulated on page 13, and they made various contributions to our profits, which are highlighted in the penultimate column on the right-hand side of this table, about £1 million in total, and that is part of our business model to invest in our funds, and as I mentioned already, we expect Fprop's earnings in particular to grow over the next 12 to 24 months. On page 14, turning over to page 14, we are really focused on developing the fund management business, and whether that be through Fprop or new funds raised. However, if property opportunities should arise for the group, we will naturally look at them as long as they don't conflict with our fund mandates. The fund management landscape is more demanding than it used to be. Fees are lower. Investors are not so keen to give fund managers blind pools of cash to invest. And so the fund management model, as it were, is slightly under pressure. We have the great advantage of being proprietors by background, and we're not shy of deploying capital. Fprop is majority owned by us, and I think that gives us quite an advantage in the current market. On page 15, we give a breakdown of the various tenancies to which we, as a group, have exposure. Some of them are Polish names with which I suspect most of you will not be familiar, but our biggest tenant in the properties to which the group has direct exposure is Carrefour, who represent 47.7% of the income that we generate in the various properties we directly own. Carrefour, when we say Carrefour, we mean Carrefour SA in France. So it's the parent company. It's not a subsidiary in Poland. At least it's guaranteed by the parent in France. So turning to the outlook and dealing with fundraising first, I've already mentioned that raising blind pools of cash is slightly difficult. We did raise £3.7 million for Fprop since the year end. 2 million of that was from the group, so it was 1.7 million of new money from high net worth individuals. It doesn't seem like a lot of cash in the context of the assets under management that the group has, but we are able to deploy this cash fairly effectively in Poland, and we would expect some pretty good returns to come off the cash that Fprop has to invest. In the UK, we are seeking to expand our investment strategy that we apply for UK PPP, and just to recapitulate that, we target discount retailers, retail warehousing, ideally where rents and tenancies have been reset since the onset of the credit crunch, and we can produce fairly attractive ungeared rates of return, as we have done for UK PPP, which at the moment is earning 6.4% per annum on equity invested. We are also looking at it's motivated really by the political landscape, but we are also looking at buying regional office blocks in the UK with a view to converting them to residential. There's a lot of government support both for the residential market on the buy side, but also government support for the conversion of these redundant office blocks to residential. I don't want to say too much about it yet because we haven't done a deal, but some of the numbers that appear to be available look attractive for such a strategy. Turning over to the economies of Poland and the UK, Poland continues to do significantly better than the UK from an economic perspective. It grew at 2% last year. It's forecast to slow down this year, to 1.2% as Europe slides backwards. Poland's biggest trading partner is Germany, and Germany, as we all know, has slowed down, so it's no surprise that Poland has slowed down. None of the respected economic commentators, such as the ECB, European Commission, Polish government, and other economists expect Poland to go into recession. Indeed, they expect Poland's growth rate to accelerate as we go through the year. One of the flip sides of the slowing down of consumer spending in Poland, which has taken place over the last quarter, has been an increase in bank deposits. Because the consumer in Poland is not as overstretched as the consumer in the UK, and the surplus cash from the slowing down in consumer spending has actually gone into the local banks. And so we do find, at least anecdotally, that the banks in Poland are keen to lend, and in our experience that presages an economic recovery. So we hope that bank lending in Poland will pick up. We're certainly finding it much easier to raise loans now than we were able to 12 months ago when we were in the depths of the sovereign debt crisis. Nevertheless, the property market in Poland remains polarized. Investors, and this is something that's very similar to the UK, investors are focused on prime property, what they describe as core property. I'm not a great fan of terminology and jargon, but essentially they're looking for stuff that they believe is safe. We don't typically trade in that market. We trade in the secondary property market, and the secondary property market in Poland has very little investor appetite for it. The same applies in the UK. Arguably, there should be more investor appetite for secondary property in Poland because income levels are likely to be more sustainable, but it is not as deep a capital market as the UK, and the withdrawal of international capital from the property market there has hit the secondary property market harder than it's hit the prime market. Having said all of that, capital values in our portfolio in Poland are down about 20% since the onset of the credit crunch, which is markedly better than they would have been had they been in the UK. And the high income yield we get off our properties there has more than made up for that capital value reduction, which we think proves our investment philosophy, which, just to remind everyone, is the targeting of high-yielding property, because we do believe that high yields make up for short and medium-term adverse capital value movements. High yields also allow you to sustain your banking positions and allow you to pick your moment of sale if and when capital markets recover. So that's basically Poland. I've touched a bit on the UK. It looks like the UK economy might be beginning to recover. Certainly we're seeing much more investor appetite outside prime London. It's still much lower than it was in the boom time, and it's still markedly less than the appetite for London, but there is an increase in appetite for going outside London. We're also seeing a greater preparedness by banks to lend against commercial property investment in the UK, and indeed for developments, which is a new thing, and that's all very positive. And if you look at some of the press releases coming out of Lloyds and other banks, they are recruiting on their property lending side, and that, I think is really positive. And then whether or not you endorse it from a political wealth of the nation perspective, the fact that the government is supporting first-time buyers, buyers for properties up to £600,000 through the Help to Buy scheme, through funding for lending, for the funding for lending scheme, and all sorts of other schemes that the government's initiating, we do think that there'll be a recovery in the residential market. And typically in the UK, when there's a recovery in the residential market, everyone feels a lot better and spending recovers, and the cycle begins again. So we're hopeful. So in summary, in terms of outlook, obviously we've got the USS contract expiring in 2015. We'll be looking at ways to replace that income through investing our monies in Fprop, as well as developing our UK business. We are a well-capitalized, I believe, well-run, strong little company, and I think our prospects are basically good. and I think at that point I'll end the presentation and open it up to questions from the telephone and within the room. Do I need to do anything other than say that? No. Yeah.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press the 0 followed by the 1 on your telephone keypad now. If you wish to withdraw your question, you may do so by pressing the 02 to cancel. Our first question comes from the line of John Borgard from Equity Development. Please go ahead with your question. Your line is now open.
Good morning, Ben. Congratulations on doing a fairly sterling job. Well, probably a fairly zlotty job in a tough time. One question on your strategy for the PPP, which you've been going into discount retailers and retail warehousing. Are you seeing any impact on the demand from warehouses from a fall in high street sales and the switch to online retailing?
Yeah, I mean, the whole retail market is under pressure, but one of the reasons we like retail warehousing, it is at the more cost-effective end for operators. Rents are typically lower, and as long as you've got a well-located warehouse, it should be a reasonably defensible asset. You also have the planning regime helping you in the UK because they're quite reluctant to grant consent for new retail warehousing for fear of what it does to the high street and for fear of further damage to the high street. So, we think it's a defensible asset class, obviously subject to what it is that you're actually buying. Having said all of that, we have seen some delinquencies over the last few years. Focus went bust, for example. And B&Q has downsized some of its warehouses. So there is a kind of changing landscape going on with these retail warehousing projects switching from perhaps the more traditional tenants to newcomers like Poundland, like Go Outdoors, B&M, The Range, Home Bargains. And, these are all relatively new names. They've traded for prior to the credit crunch, but they've really come into their own since the credit crunch kicked off. And when I say we target discount retailers and retail warehousing, we're really looking at both of those in tandem. And so ideally we're looking for a retail warehouse that was let to a tenant that's gone bust and is now let to Home Bargains at a rent that's much lower than the previous rent, and you've got a nice new lease, to a tenant that should do well over the next 10, 15 years. And
that gives you some upside potential on the rent when the rent review comes in.
Exactly, and if there's a recovery in the UK market, once you then start to see rents ticking up.
Thank you, that's reassuring.
Thank you. Our next question comes from the line of Brian Geary from Private Investors. Please go ahead with your question. Your line is now open.
Hello, Ben. Could you explain the change in cost of sales line in the report? It's gone up from 1.3 to 3.2 million.
That is the cost of the property sold, Brian. So we sold that Baja property just before the half year.
Yeah.
And you've got to put the whole purchase price through the P&L.
Because it's held as an inventory.
Because it's held as inventory.
That cost. Yeah.
Okay. So there's an element that goes in the revenue line and an element in the cost of sales line, is that right?
Got a couple of million, roughly, for that.
It's shown in note 3 under segment.
Yeah, so if you go to note 3, Brian.
Okay.
I don't know if you have page numbers on what you've got, but it's page 15 of the preliminary announcement.
Is this under segmental reporting then?
Exactly, note 3, second column to the right, first number, 2.309.
Okay.
Is the
Okay, that's fine. I'll take a look at that later. The other thing was you mentioned earlier on about a deferred tax asset reversal.
Yeah.
Could you explain that a bit more?
Well, the way I understand it, and George may need to correct me if I don't get it entirely right, but we lent money from the UK to Poland in order to buy the asset that we sold. So we had shareholder loans set up between the UK and Poland.
Okay.
The zloty, I've got to get this right, the zloty moved.
Yeah.
So the liability of those shareholder loans in the Polish entity increased, reducing the tax charge or creating a deferred tax asset, and that suppressed our tax charge in an earlier period. But the auditors, when they did their review, asked us whether we felt that we would be using that deferred, would we put new business through this SPV, this company in Poland, in order to utilize the tax asset, and we said we did have an intention to do that, but we couldn't say with any certainty that that would happen quickly. And because we can't say that it's going to happen in the near future, we have to reverse the deferred tax asset. The deferred tax asset still sits there, and we still have the right to use it in the future, but we just can't recognize it in the accounts.
That's correct, yes. Yeah.
I got that right.
Yeah.
Okay, that sounds
Yeah,
right.
there is another angle on it, but that's essentially right, yeah.
Okay, thank you.
Thank you. Once again, ladies and gentlemen, if you wish to ask a question, please press the 0 followed by the 1 on your telephone keypad now. Our next question comes from the line of Sebastian White. Please go ahead with your question. Your line is now open.
Hello, Ben.
Hi, Sebastian.
A couple of questions. I'll take them one at a time. Can you just talk a little bit about the fundraising environment? You obviously highlight some funds that are raised after the year end, but can you quantify exactly how much was raised during the financial year you're reporting on?
None.
None. I mean, I suppose that surprises me in the context of what I see from other fund managers and obviously the amount of liquidity around in the market.
Yeah, I don't know, Jeremy, I've got our marketing director here, so I might just duck that and hand it over to Jeremy.
We are in discussions with a number of parties about setting up new funds for them, but the way that we run our funds is as closed-ended vehicles. So we don't have an open-ended fund that we can just take subscriptions in on a monthly basis. Each time we set up a new vehicle, we need to achieve a critical mass before we can create the new vehicle, and that has an impact on our ability to accept subscriptions. For instance, we've got someone that wants to put 5 million into our UK strategy, but they want a pooled vehicle, and we don't have an existing pooled vehicle that they can subscribe into.
I think, sorry to interrupt, but I think the key here, there are two legs to the answer of this question, Sebastian. The first is, we were on our back foot last year looking at what was going on in the sovereign debt crisis and what was happening to capital values in Europe and so on. And so whilst we looked at lots of property, we had to be pretty damn confident that we weren't overpaying for it, and that was a very hard thing to do last year. I think it's fair to say, and Jeremy would agree, that if we find a deal that we like a lot, raising money for it won't be difficult.
Yeah.
We've got very good relations with a lot of people who would back us, but we've got to believe in a property, and we don't take a two-dimensional view of our responsibilities. We don't take the view that we're merely employed to execute to the best of our ability a given strategy. We take the view that we should go on analysing whether our strategy at any given point in time should be applied. And last year we were extremely nervous about what was going on, so we find it very hard to make purchases last year anyway. And then the other point is, we disagree, I suppose, with the institutional approach at the moment, which is that they don't want to back blind pools of cash. We think that it doesn't work well for institutions and makes a fund manager's job virtually impossible to deliver, for the benefit of the institution. Because when you say to a fund manager, I'm not prepared to give you a blind pool of cash, you're basically saying two things. You're saying, go out and get me some seed property which I can look at, and a small entity like us can only get seed property put together if we offer to overpay for it, because we've got to hold the vendor steady while we then go off and get the institution in, or we have to incur massive upfront costs to set up some kind of open-ended structure which we can then scale up. And the fund manager, we can't take that risk. So, for example, we looked at property authorised investment funds, which is the latest tax-efficient way. It's effectively like an unlisted REIT. But just to get to base one and to cover all the regulatory costs required to operate at PACE, you've got to have about 100 million under management. And, you can't get to that level in a sensible way without having blind money. And the institutions aren't on for providing or trusting fund managers with blind money at the moment. And so we think, there are pressures on the fund management industry. Some of the bigger names, Sebastian, like, household names in the fund management business, may be able to raise greater pools of cash because of their apparently better and longer track record. But a company of our size needs a different approach.
Okay, so two follow-on questions from that then. One, do you consider whether you would be better off as part of a larger organisation? Because clearly you have got a good track record, yet that hasn't really been developed into generating strong growth in funds under management. Secondly, I suppose you've been out marketing and clearly have access to pools of funds if the right deals become available. What level of funds do you think you have access to if you can line up the right deals?
Well, that's a sort of private equity type model. Just answering your second question first. I don't think access to capital is the restriction. It's the deal flow. It's getting the right deals. And we would need to find deals in order to get significant private equity type money. You've got to find deals of 30 to 50 million. Anything south of that doesn't really get private equity investors particularly excited. And it's not typically an area that we play in. So, we're looking at raising smaller pools of cash from high net worth individuals, investing it, and then coming back to them for more money. And Sebastian, can you remind me what your first question was?
Well, yeah, you mentioned obviously other larger fund managers have great success in terms of getting these blind pools. You've clearly got a fantastic 7-year track record in Poland, and I'm unsure what your UK track record is yet, whether it's of meaningful duration. But would that be a better way to utilise that performance track record being part of a larger organisation? Yeah,
no one's come knocking on our door, but we like being niche property fund managers. We don't really want to be a broad spectrum allocator of capital into some predefined policy-driven geographical investment approach. It's not what excites us. It's not what we want to do. We want to make superior rates of return for our investors. And I'm not sure that really answers your question, but we don't really want to be part of a.
That's fair. No, that does answer the question. Happy with that.
Polish strategy is more suited because of the high returns that we generate and the leverage that we use to generate those returns. Our Polish strategy is well suited to high net worth individuals, less so to the institutions. Our UK strategy, which is much more core, we would like to attract institutions to set up separate accounts with us. It's just a slow process.
Okay, so a slightly separate question then, just understanding how you would replace the fees earned from 200 odd million from USS with Fprop. They just seem on a different scale to me.
Well, just very roughly, what we earn from USS is about 3 million euros a year.
2.8. Yeah.
2.8 million euros, which is about
3 million.
Yeah, okay, which is about 2.2 million sterling or something. Okay, and we've got 12 million of cash. If we can earn 15% per annum on our cash, and we've got a track record of doing that, that's about 1.8 million. So we're 400 shy. Are you with Sebastian? We're 400 shy, so we need a fair wind, a few extra deals, and I think we're there. So, I'm pretty sanguine about it, and we are seeing some really interesting deals at the moment.
Okay, so obviously you're fairly adamant that the USS portfolio is going to be wound up. There's no interest in someone else taking over that fund wholesale, or I presume you've tried going down that route?
Well, we haven't tried. We're only beginning to. The fund expires in a couple of years, so we're only really beginning to deal with that expiry. But the mechanism I think we would wish to adopt is to make sure that we get, the best price reasonably obtainable in the market. And, I think we need to go to market with properties and test the market.
Is that is 200 odd million of Polish property in the context of the transactions going on, a material thing? I mean, how long would would you do it sort of one by one over 2 years? Is that what you're?
Yeah, I mean, I think we'd maybe do it slightly faster than one by one, but that's the basic approach. And the turnover in the Polish market last year, I'm just flipping back to page 18, was 2.6 billion. But actually, the very large bulk of that 2.6 billion was made up of about 17 transactions. And so 200 million in the context of the part of the market in which we operate is indeed a very significant amount of capital.
And if you can't realise them all by the time it's handed back, what happens?
Well, the fund presumably continues. The financing is in place. Everything's pretty solid. We have to discuss with USS, how we resolve that. But at the moment, we're pretty confident that, notwithstanding the fact that it's quite a large amount of capital hitting the market, that over a period of 2 years we should be able to obtain the best price reasonably obtainable.
And presumably you could bid for a few yourself?
Presumably. I mean, that's one of the reasons we need to go to market, so that if we do bid for properties, it's quite clear that we've bid market price.
Sure. Okay. Right. Thank you.
Thank you. We have a follow-up question from the line of Brian Geary. Please go ahead. Your line is now open.
Just on the Polish aspect and the wind-up of USS again, are the Polish management team's costs currently carried within the USS fund, and if it winds up, would you then need to get rid of that overhead, or do you effectively lose critical mass to operate in Poland, really is the question?
I mean, clearly if we stand steady and we don't do anything to buy new Polish property, that will bring pressure on the team. Their costs are not met directly by the USS fund, they're met by First Property Group. They're our team.
Okay.
And they, I think, are huge intellectual resource that we've developed over the last 8 years since we've been in Poland. And I think they're great people, they work extremely hard, they're very capable, and it would be a great shame to lose any of them. But, clearly their fortunes and our fortunes in the UK turn to some significant extent on our ability to deploy capital in Poland. And, we work in a capitalist system, everyone in the company understands that. And if earnings were to move backwards and there was no real prospect of them moving forwards in Poland, then we would have to look at our cost base in Poland. But at the moment, that's certainly not on the cards. And we would wish to utilise that enormous intellectual goodwill for the benefit of the group.
Okay, so their costs at the moment effectively come out of that €2.8 million fee income?
Yeah, and we've got other properties in Poland too. We've got funds in Poland.
Allocated.
Yeah.
Okay, that's great. Thanks very much.
Thank you. As a final reminder, ladies and gentlemen, if you wish to ask a question, please press the 0 followed by the 1 on your telephone keypad now. As we appear to have no further questions, I return the conference to you.
Great. Well, there are no further questions. Any questions in the room that anyone would like to ask? So I think, unless there are any further questions, I think we'll bring the conference call to a close. And thank you very much, everyone, for attending. And look forward to delivering, hopefully, continued good results to you and our shareholders. Thank you very much. Bye-bye.
Thank you.
Bye.
This now concludes today's conference call. Thank you for attending. You may now disconnect your lines.